and gentlemen, and welcome to my bedroom.
Good morning.
That's not something I thought I'd say. There you go. I usually do these sort of roundtables in the same room as the panel. I've never done a sort of digital hosting discussion before, so let's see how this goes. I've met most of you before, either prepping for this roundtable at previous roundtables or even on a train on them. Yeah, occasionally.
Yeah.
For those of you who don't know me, my name is Mark Dunn, and I am the editor of Portfolio Institutional. And I'm going to be your host for this discussion, which looks at cash flow driven investing, which if we'd have held this discussion in December, I'm pretty sure we would have had a very different conversation than one we're about to have today. World events as they are, and COVID-19's influence over not just the markets but economies makes this a very, very timely discussion to catch up, to find out exactly what's going on. We'll start with a little bit of housekeeping. We're recording this conversation, and an edited version will appear in a special supplement, but also be uploaded online. And Will, who you saw at the beginning there, who's now hiding, he's going to try and take some screenshots, perhaps. If you can put it off, we're all new to this ourselves. So my advice is to keep smiling at all times, because you never know what might be appearing. Definitely. I always think it's a good place to start if we know exactly who he is. We're talking to each other. I know some of you may already know each other, but I think a few words of introduction might be great. Claire, can we start with you, please?
Yes, well, I'm Claire Buse. I'm a fixed income portfolio manager in the institutional public debt team at M&G. I am also a member nominated trustee for the M&G pension scheme.
Okay. Norbert?
Hi, I'm Norbert Fullerton. I am Head of Institutional Client Strategy for Europe, Middle East and Africa at Janus Henderson. My previous kind of incarnation, so to speak, I've been a consultant at Mercer and Willis Towers Watson and Russell Investments as well. So vast consulting background. I'm now on the bright side of asset management. So it's a lot of fun, but I'm responsible for thought leadership. I'm responsible for the solutions that we do for our clients.
Gotcha. And Kunal?
Hey everyone, my name is Kunal Chabda. I'm a Director of Fixed Income at B Finance, covering public markets, fixed income strategies. Previous roles, I've been engaging in manager research for a while, previously at Buck, with Celine over there, and prior to that, sort of portfolio management, fixed income and multi-assets across various roles.
Gotcha. And Celine?
Hi, good morning, Celine Lee. I'm an investment advisor with Buck. Been in the industry 20 plus years. Look after a portfolio of clients from a few $100 million to a couple of billion, and have indeed worked with the managers here to put in place a CDI strategy towards some of the clients. So looking forward to talking more about it and how it works in practice.
Honoured.
Hi, my name's Anand Quatra. I'm an investment actuary. I work for the Phoenix Group in a division called Phoenix Group Capital, and we're responsible for the group-wide initiatives of sourcing and risk management of the liquid assets for the annuity funds and other group risk management initiatives. Most of my career has been in life insurance within other areas of insurance investment, like asset liability management and valuation.
Gotcha. Danesh?
Yes, good morning, everyone. Dinesh Visavadia. I work for Independent Trustee Services. So we're a firm of professional trustees. I've been with them for over like 3.5 years. Prior to that, I was on the corporate side of pensions in various roles as head of pensions or pension director at JP Morgan, Royal Mail, John Lewis, Britvic. And currently I have a portfolio of clients, schemes that are both DB and DC clients as well. And I work in the charity. I'm also a charity trustee as well.
Okay, thank you, Dash. Thank you. And last but not least, Mr. Weeks, David.
I'm David Weeks. I'm co-chair of the Association of Member-Nominated Trustees, who represent pension scheme member-nominated, as it says on the tin. In terms of scale, we've got about 800 members, and in terms of scale, before these events which we're about to talk about, they reported that they had assets under management of a bit under £1 trillion sterling, but obviously that figure is considerably lower now.
Gotcha. Okay, guys, thank you for that. That's great. Now, CDI strategies, they're built to sort of generate cash for insurers and pension schemes, but I'm sure the events and the effect on the markets and economies might be testing those strategies at the moment. Anand, if we could start with you, I do get the impression that Phoenix on the investment side must be one great big CDI strategy. I mean, how are the events of the past month or so, how are they making you guys think back at Phoenix?
Yeah, I mean, I'll start off with the first fundamental point is, yes, there's been short-term volatility and this will have long-term implications, but it doesn't fundamentally change what we have to do for the annuity fundage, which is source long-term investments with a mix of inflation to match those long-term liabilities. I think what's going to fundamentally, which is certainly changing at the minute, is how do we assess the credit risk in those investments?
Yes.
And actually, it's the liquid portfolio which is receiving a little bit more attention than the illiquids at the moment. So, you know, as an insurance investor, we're very concerned about you know, downgrades from a BBB area, because that can you know, have a sort of an exponential effect on capital. So at the minute, we are closely looking at our, you know, liquid portfolio and BBBs and trying to assess which exposures are very prone to downgrade and default risk, and, you know, trying to think about mitigating rebalancing actions, you know, to bring the portfolio you know, to a slightly more resilient position. So that's more on the risk management side. I would say another thing on the illiquid side we're seeing is obviously the opportunity set is being affected. So, you know, we are seeing you know, various deals being postponed, you know, issuers now being tentative coming to market. We've seen that quite a bit in the social housing sector, which is a very popular asset for matching long-term liabilities. So, you know, deals being put on hold. You know, there's obviously concern about liquidity even in the corporate bond market. Can you actually buy the corporate bonds at the prices you see on the screen? You know, that's an issue. And also, I mean, you are seeing what, in inverted commas, potential opportunities. So, you know, spreads are widening in sectors you think are relatively low risk, but you still need to employ caution in this environment.
So, Dinesh, with the schemes that you work with, I mean, how are they seeing this at the moment? Is this a time for concern, or, as Anand just said, there may be a good opportunity to get in as spreads are widening?
I think at the moment, people who are already in the scheme and well through the scheme strategy, I think they're just saying, let's just pause before we move to the next step, because you can never implement these things in one go. So those which are partway through the journey are saying, let's pause till we get some stability in the market. Opportunities are rare, as Anand was saying as well. So we just need to be selective in terms of whether we can carry on the strategy and complete it in a sensible way. So that's, we definitely know that we're not, I'm not seeing any new strategies being implemented in this area at this point. So people want to go down the route of doing a CDI strategy, but they have just halted that, because I don't think there's possibility of actually trying to get buy-in what all the investments that you need to fully implement that CDI strategy. So that's I think pausing is probably the word at the moment, and with uncertainty and volatility, I think trustees naturally get very conservative in this area. So just making sure. Sorry.
No, thanks, Dinesh. It's not a great line with you, so if you could hold the microphone a little bit closer next time, that'd be great. Okay. Thank you. And David, how's the turbulence we've seen in recent weeks? Is that giving your members, your cash flow focused members, even less sleep than usual?
Yes, I mean, I think at the moment we're conducting a straw poll actually to test out the immediate reactions. I think in very broad terms, the sort of top line picture is that you could draw a distinction between those who have an emphasis on the short term implications and those who are inclined to take a longer perspective. To some extent, I think there's a generational aspect at it, that the younger trustees are looking at instructions from the pensions regulator on how your triennial valuation is working out, whereas the those of us who are sort of longer in the tooth can look back to the 1980s and say, in the crisis of 1987, if you took a longer perspective, if you allowed things to settle down, some of the immediate pressures would disappear, and you'd then be able to continue on a more even sort of keel. So I think it's sort of quite a volatile position at the moment, but the generational aspect of it may be quite a key element in how people respond to that.
Okay, thank you. And Claire, if you could just talk about fixed income. I mean, how's this affected the fixed income market? And talked there about liquidity. I mean, is that a big issue at the moment? Is that what people are talking about or asking about?
I mean, certainly there has been a significant impact on liquidity in the market during the current crisis, and it has been difficult to transact. Not impossible, but quite difficult. What we're finding is that the brokers have much less ability to take risk onto their books. Clearly, everybody is working from home, so there's operational friction introduced as well. So it has been a challenging market. Thinking about my CDI clients, clearly those clients who are well matched, actually for them liquidity is less of an issue, because if you're well matched, you shouldn't be a forced seller. So you should be able to sit back and watch this volatility, perhaps take advantage of it if you can, if selectively you wanted to add some corporate bonds, some credit into your portfolio, obviously quite carefully. But the liquidity for a well-matched portfolio is less of an issue.
Gotcha. Norbert, I saw you nodding along there to Claire, talking about if you're already matched, that's fine. But if, as the IMF are saying, and other organisations saying, where the world is heading for recession, quite a deep downturn, is there maybe a heightened risk of default? I mean, is that an issue that people are worried about?
Good question, and Claire kind of stole the words out of my mouth just now. But the main beauty of CDI, as Claire hinted earlier, is the fact that you're not too worried about short-term market volatility, because you're investing in long term. If you're reasonably well matched, or even if you're overmatched, then you can ride this out, because you're one of the beauties of CDI is that you're investing on a buy and maintain basis. Mm-hmm. So you're not too worried, assuming of course the portfolio that you're holding is reasonably well kind of constructed. But those pension funds that haven't been reasonably well matched, then I guess that's a challenge for them, and they need to be relatively nimble if they can take advantage of some opportunities of some spreads widening potentially. But they really do need to be thinking about some of those. I've seen a couple of pension funds who are just kind of waiting and seeing, because it's a little bit early still, even though we've already gone through a month of this coronavirus kind of lockdown kind of scenario. But for those who are reasonably well matched, they should be okay. And for those who aren't, then they're probably going to wait until they're on the other side of this to see how the markets have behaved and whether or not they can actually take some opportunities, particularly an investment grade credit, because those have been reasonably expensive in the recent past. And if spreads are widening, there's a potential buying opportunity there.
Good. And Celine, you're an investment consultant for schemes that aren't well matched. I mean, what are you advising those guys? How are you working with them?
Yeah. And I think this is where I see a range of clients, from the ones that have really embraced CDI, have implemented it, those conversations versus the ones who are sort of halfway through implementing it, and then you've got the other end of the spectrum who kind of think, oh, don't worry about liquidity, worry about it when it happens. I mean, the range of outcomes and conversations are completely different. And if I start with the ones that have actually done really well by really managing the CDI strategy, I have to say those conversations are a lot easier. Apart from understanding, market volatility and what's happened, they know they're in a very good position. That said, we are seeing unprecedented amount of unexpected cash demands as well, which to some extent people haven't anticipated, and we haven't had a crisis for a long time. So, for example, employers coming along to say, sorry, I'm going to switch off and defer contributions. So that is something unexpected and quite unusual. LDI strategies suddenly having deleveraged a collateral cause, which again, those can be sizable and unexpected. So I think what this reinforces is that we need to be ready during normal times with a CDI strategy, so that you are in a much better position to weather those unexpected events or unexpected cash demands when we are going through real turbulent times. And then the other end of the spectrum is that I think for the schemes that are either halfway through implementing it or about to start, I think that this is a real good time. Nothing like a real turbulent market to be saying everyone needs cash, and for it to be staring at you in the face, and people will then believe, yes, actually, we do need to manage cash flow and liquidity in a much better way than they have done before. I think normally people are sort of aware they need to do it, but maybe not everyone completely buys into it until it happens.
It's a wake-up call. Okay, Kunal, I mean, how should cash flow focused investors be reacting to the turbulence at the moment if they're not well matched?
Yeah, I think I'd agree with Celine at some points, and I kind of have a bit of concern about that triple B risk at the moment. And with investors who are already in CDI by maintain match strategies, I think this is a bit of time to really engage with your managers and try to understand where you're positioned. I think one of the troubles over the last couple of years, as we all know, spreads have been incredibly tight, which has led a lot of matching strategies to pick up that yield that schemes need to actually sort of maybe allocate a bit more to that triple B spectrum. And it's not just triple B that's really impacted by this. It's that entire IG spectrum. So whilst you are in a match strategy and technically you don't really need to worry about the mark to market because it's short term, the implications of what's going on is going to be a lot more far reaching than just short term credit, which has been impacted in the past few weeks. I think a lot of the investment cases for issuers has been particularly challenged and changed in some cases. So whereas you might have been comfortable with a single A rated credit a year ago, there's a good potential that that single A rated credit may not be what you want to be holding. On a sort of 5 to 10 year view at the moment. At the moment, it's very early, albeit to sort of take those kind of to make those kind of forecasts and make those calls. But I think that goes back to the case of really engaging with managers, which we've been doing here for the past couple of weeks, to really get a steer on what's going on in markets and how liquidity is really being impacted. And the other side of it is new issuance and maturities coming up for the next couple of years within IG, which I think is a real kind of sort of bellwether for what's going on in new issuance markets at the moment. So you're seeing a lot of new issuance coming, particularly from the US investment credit market. A lot of that is on the back of perhaps maturity walls coming up this year and in the following year, hoarding cash, to sort of try and weather the storm. So in a roundabout way, investors that are able to take those kind of steps towards implementing a CDI strategy at the moment, I think there's some real opportunities there. Spreads are really widened out, so you can really pick up some high-rated credits at the moment with much wider spreads than you were about a year or two ago. But at the same time, it's very, very a cautious approach I'd suggest you need to take. managers need to be very, very selective, not particularly on a sector's basis, but on an issuer by issuer basis. There's equally sectors that are troubled and directly impacted by what's going on, that have very good individual issuers within there that you'd be happy to hold. Equally, there are sectors that perhaps aren't directly impacted at the moment that have issuers that you wouldn't be comfortable holding at the moment. So it's down to some very, very thorough bottom-up due diligence on the part of fund managers.
You talked about that there are some opportunities there, and a few of you have mentioned that. And Arne did actually mention assessing credit risk. I mean, how easy is it these days to look at an asset and assess its creditworthiness? I mean, Norbert, is it just too early to say yet?
Yes, it's a little bit too early to say. One of the things that we're looking at on the fixed income desks are the true assessment of the illiquidity, and so we're looking at that a lot more closely. But it is very, very difficult at this point to come up with any sensible conclusions, if that makes sense, because things are changing on a daily basis. What was reasonable yesterday is almost completely gone out of the water today. So it's a fair point. I mean, assessing liquidity or illiquidity within fixed income at this point in time is challenging. One of the things that we're looking at is just making sure that we're engaging proactively with the companies that we're holding, with issues that we're holding, and just making sure that we're looking at it on a regular basis and assessing our client needs, assessing the assessed illiquidity or the changes in the liquidity measures that we're seeing. But we haven't been able to come up with any sensible conclusions that will cause us to make any wholesale or radical decisions at this point in time, within particularly our buy and maintain strategies or some of our investment grade ones as well.
Okay. And Claire, does that go for you? I mean, how are you approaching new assets these days?
Well, as others have mentioned, fundamental research is crucial right now. And I'm fortunate to have a huge team of analysts who are able to do that fundamental research for me. And clearly it is, as Kunal said, it's on an individual case-by-case, issuer-by-issuer basis. And we are looking for assets where the balance sheets are significantly robust. We do expect downgrades, and we may indeed purchase bonds perfectly in the full knowledge that there is a very strong likelihood of a downgrade, say from low single A to high triple B. But if that is priced in, if that's already the price that's in the market, then and we are happy with the underlying credit fundamentals, then we will selectively buy those assets.
That sounds like a lot.
It's an interesting point about the new issue market, and clearly there have been lots of opportunities in the new issue market. Now, actually, I would argue that these are some of those new issues, particularly in the US, are coming at very attractive levels. And actually, these are companies who are seeing an opportunity to bolster their balance sheet to weather the storm.
Okay, that sounds like a lot of good common sense there. Arne, is that how you're approaching things on your side of the fence?
Yeah, I mean, as people have previously said, there is an element of pausing, but there's also an element of just going back to the fundamentals. So in a CDI strategy, which most annuity funds are, you're forced down to by the PRA regulations, you've got to think long term. You ultimately want investments which are going to deliver the cash flows when you need. And it is making us think a little bit more that, government-backed sectors, local authorities, social housing, things with a government guarantee. The recent episodes have shown that there is a sort of backstop, and it does make you think, well, these are investments which you can rely on to deliver the cash flows over a longer term. Clearly, though, we are putting a lot more scrutiny on more cyclical type investments, and that's where we are looking at the liquid portfolio and seeing if it can be rebalanced. A comment earlier was made about the spread widening compensating for downgrade risk. I think that is something we're sort of thinking about as well. So, you have seen spreads widen, particularly in the social housing sector, which was always on a potential downgrade trajectory because of its market sales exposure. So you could argue, well, those investments will deliver strong fundamentals over the long term, and if there is any short-term downgrade risk, it is priced in, and you'd be potentially comfortable, taking on some of that exposure.
Okay, change things a bit around now. What sort of assets are proving popular in CDI strategies? You talk about that some schemes are already fully matched. I mean, what sort of assets are they investing in? Dinesh, can you talk about some of the things your schemes are backing?
Yes, I think buy and maintain credit. I think the entire spectrum of the liquid credit market, I think we can fit into that. It is just a question of what returns and yields that each scheme needs. So it's quite a lot of excitement there, multi-asset credit type of arrangements. Also on the illiquid side, we're seeing ground rents and perhaps infrastructure debt as well, that people are factoring in as well into the process. Can you hear me okay, all of you?
Yeah.
Good. So I think it's so ground rents and infrastructure debt is also becoming quite what I'm noticing in our strategies coming through. But I would like to ask a question to the colleague, to the people around the table who are in the asset management world, is whether the duration is shortening on the CDI strategies or not, because in the current environment. So if they can answer that question at some stage, that'd be helpful. But those are the sort of the typical asset classes that I am seeing in the markets at the moment. Clearly, we have an issue with the longer end of the spectrum where it's not sufficient. We don't have sufficient supply of investments, from what I hear, in order to match your cash flows. But at least you can get part way through matching it in some form or shape.
Gotcha. And anybody else got anything to add to that in terms of the type of assets that institutions are buying?
I think, Mark, one thing, the expression I picked up from what you said earlier was too early to say yet. And I think that a lot of the trustees are taking that view and flowing from that they're looking for don't or try and exchange like for like, so you don't sell at a low point and have to buy at a higher point. In terms of the sort of ends of the spectrum on that one, the issues that are concerning, I think, to many trustees, especially the smaller ones at the bottom end, the phrase was used, unanticipated cash demands, and in a small scheme, one or two big putative pensioners who want to transfer out can make quite a significant difference to the scale of things. So I think that people are looking at the potential timing of that. At the other end of the spectrum, assets which are causing problems, I think that perhaps because it's more close to the popular imagination, people are nervous about property assets in terms of schemes, property funds potentially closing down, and certainly the implications for what could be quite significant structural changes in the economy, like the downgrading of the the reason we're here today, we're not in offices, we're sitting at home, the demise of the office sector and of course the retail sector as well.
Yeah, just back to that point on property you just mentioned. That's something which is sort of commonly, been cited in insurance for the last couple of years. There's a build-up of property exposure, and I think one way sort of to mitigate that is just ensuring appropriate diversification across things like equity release, social housing, CRE, your ground rent, etc. Because the property risk is going to come through in different ways and affect things slightly differently.
It's an interesting point, because people are buying these real assets because we were told that they could keep good quality, repeatable cash flows, quite defensive in some ways. But have the real assets they've been in the CDI strategy. Now there's a disruption. Are they living up to the hype of what the marketing used to tell us? I mean, how are they performing?
I think on the
I think one of the
on the real asset side, because you don't see that, daily fluctuation in liquidity levels per se, for example, then, again, for pension funds, they're just holding it on a wait and see basis. They have the beauty of being able to invest for the long term. I mean, one of the other things that I've been seeing is for some pension funds, because they don't have the insurance regulation requirements, they are perhaps taking slightly a little bit more risk and investing in, for example, some things like defensive equity income, particularly for those pension funds that are slightly less well funded. They still have the usual gilts and band maintained credit and some multi-asset credit and high yield inside there. But perhaps investing in just a satellite allocation, a small portion of their portfolio, even though it's not contractual income. Some of the evidence does suggest that there's a long track record of reliable income coming through low volatility than, say, the regular stock markets, et cetera, et cetera. So some of these pension funds are looking at that. Some have started to invest in it. Some that have, over the last couple of years, some pension funds have just switched on the distributions for their existing asset strategies.
Okay.
But some of them have now decided to refine those a bit more and kind of evolve some of those distribution type assets into more of a cash flow driven type strategy, and looking at, as I mentioned, defensive equity. They're looking at things like multi-asset credit, ABS, and so on, even though those are slightly shorter dated, but slightly higher yields than investment grade. So they're able to invest in those and provide the cash flows that they still need.
And Celine, do you have anything to add?
Yeah, so I think when it comes to what type of asset class and what counts as CDI, and the key word here I think is contractual. Now, apart from those that are running a very low risk, almost quasi annuity book type of pension scheme clients, many still rely on some degree of growth. It may not be equity type of growth, but somewhere in between hybrid type assets. We have seen that in recent weeks, even some of the lower risk private debt type instruments that were going to distribute decided then not to distribute. So I think it goes back to, well, how much, to what extent you can actually rely on the income being paid. And that's where the schemes with more of a growth element, or where they rely on more of the growth element, will have to allow for the fact that guaranteed income has a price to it. You can't have a guarantee and very high return. So if you really, really need a very high level of certainty of getting those income, then you're going to have to sacrifice it in some ways to have lower return to get that guarantee. And that moves us into the spectrum of, property, long lease property, to what extent we count those as income. And I think that's when people who are willingly in wanting to pursue the higher returns often have to accept that, yes, of course, there will be times that those contractual income may not be as contractual as they thought. And that's just something people have to allow for and understand that even within a CDI strategy, you've got a mixture of assets, and you can't have your cake and eat it too.
Yeah, I'd go along with that. The balance that changes between income guarantee on the one hand and high return on the other, that we may see some changes in that, and that I think the trustees will be keeping a very close watch on what seem to be the trends in that development.
Yeah. And I just add as well, if I can, is that
Yes.
I think the CDI strategy is only coming into the pensions scenario not long ago, actually, I can remember. So we haven't been doing CDIs in pension schemes for as long as the insurers have been. And I think somebody, as schemes have matured and got better funded, CDI strategy was sort of introduced with a view to some of the schemes which are actually on a route to buy out or buy in, whichever the case might be. And that really set the whole scene for undertaking or implementing a CDI strategy. And what has happened in the meantime is that components that make up the CDI strategy have actually gone from a very simple set of components to some very sophisticated ones that we have today, and which is very good, because that's just the innovation of the asset management industry. But how do you actually source some of this, and how do you test that? And from a diversification standpoint, is also proving challenging as to what the CDI strategy risks are underlying there. And that's one of the challenges I, as a trustee, have quite a lot of issues with and concerns with.
Gotcha.
Yeah.
Okay. Sorry. Okay. If you've mentioned growth there, you don't necessarily associate equities with CDI, but they are, some of them are quite high, solid dividend payers, as long as they're not banks at the moment. So, are any of you seeing equities in CDI strategies and how they think they might perform? Or is it just too growth? Claire, go first, Claire.
So, I mean, I have a view that assets in CDI strategy should have contractual cash flows, or as contractual as you can make them, and very clearly equities do not have cash flows, and we're seeing that very, very clearly right now. Dividends are being cut, not just in the banks, but across many sectors, as companies are conserving cash, quite rightly, and so. Personally, I don't think that there is a place in a CDI strategy for equities. Now, there may well be a place for equities in an overall pension scheme strategy, particularly if they're immature and they need that level of return. But from my point of view, they don't belong in the CDI strategy.
Yeah, just to echo that point about equities. The whole point of a CDI strategy is to give you the cash flows you need to pay your liabilities, and this is why insurance regulation won't allow equities to be held in an annuity fund. And in fact, when we see a lot of new investments with an equity-like component, leverage loans or equities, we have to actually restructure it, separate out the equity component and the fixed cash flow component, and we're only allowed to hold the fixed cash flow component within the annuity fund, and the equities the equity-like risk has to be held somewhere outside.
Gotcha. Okay, so from what I'm hearing and the way things have been performing since disruption, should CDI assets be public or private markets, or a mixture of both? Where should schemes be sitting, if they're looking for cash, of course?
Well, private assets generally have contractual cash flows, so I would argue. But like insurers, pension schemes can think about holding both public and private assets. Private assets can bring other benefits that aren't available in the public markets. They can offer high yield. It does depend. Clearly, it's been a very popular area, and yields have been coming down in private markets. But they can offer higher yields for lower risk. You can get covenants, and of course it does add diversification, particularly at that longer end. So a number of people have mentioned the difficulty in investing for cash flows at the very long end of the market, and private assets do allow you to add some diversification there, where in public markets there are just fewer issuers issuing out, say 30-40 years.
What do you think about that?
Sorry.
Yeah, can I?
Oh, sorry. Yeah, I think it also depends. I'd echo Claire's comments. I think there's definitely room for a mixture, but it depends on the ability of the scheme to actually access those kind of investments on the private spectrum. So clearly, those larger schemes have the governance budgets and ability to take on those kind of strategies and incorporate them. The smaller schemes that necessarily don't. There have been, I think, introduction of liquid versions of illiquid, well, shall we say, not illiquid, but private asset vehicles available, which can be accessible by smaller schemes. But I think they're still very early days yet. But look, I think, very, very, very sort of much echo Claire's points. Things like infrastructure debt, for example, very, very long duration assets can help to sort of pad out those kind of long dated liabilities. mixture with sort of medium term and short term matching through public market assets. And don't forget, there's a lot of diversification through the fixed income spectrum. If you're looking at the entire asset class availability through multi-asset class approaches, so there's a lot available there to schemes.
Gotcha. Norbert, do you have anything to add?
I agree with Kunal that there's a wide spectrum of both in public and private assets spectrum. Particularly on the public side, within fixed income, we know it's a very broad, deep, and wide market, and so there are sufficient, or there are more than enough asset classes there to provide some form of diversification. Whilst I'm not going to push it too hard, there is, how do we define CDI in terms of, are they contractual assets per se? And there isn't necessarily, I know within the insurance spectrum, there's a difference there for the capital requirements, but on the pension scheme side of things, when I've held so many conversations with trustees particularly over the last couple of years, where they've been struggling to find assets at the right price that would generate income. And some of them have, based on their advisors, advising them on some of these things, some of the defensive equity income has kind of come through and helped them a little bit. Again, I mentioned it's just a relatively small allocation. And whether we call it CDI or non-CDI or just part of their wider portfolio is something to be, I guess, debated, but perhaps not here at this particular point in time. But certainly, when you're fully funded and you're fully matched, and you want a low risk strategy on a kind of a self-sufficient basis, having a really good diversified mix of assets that provide contractual income, low risk basis, that is certainly the type of portfolio that you need, both across private and public sectors.
Mark, I've got a sort of comment to make, or observations rather. When we're thinking about what goes into the CDI box, if you like, and there'll be sort of varying degrees of opinions and different shades of contractual income we're talking about. But if I look at sort of the traditional buy and maintain credit, perhaps through to more of the property-related, long lease property type assets, for example, one of the things we do find can be a challenge is, obviously, in this box, you can probably have something like three to five types of asset class that might go into it. And the schemes that follow the CDI strategy tend to be the more mature schemes and the better funded ones. And therefore, naturally, what they want is lower governance. So having an efficient governance budget, not to have to manage, 3, 4, 5 different types of managers, but somebody who is still very good at managing each of those sleeves and those each of that asset class and element. That can potentially, I think, be a challenge. And if trustees, pension schemes can find those types of managers who are genuinely actually good at all of those different elements, I think that gives them a much higher number of ticks, if you like, in my mind, which is not just about asset class, but also about the practicality of how investors manage the relationship with the managers going forward as well.
Yeah. I just wanted to echo an earlier point Claire said about, private debt. It can function for things at the long end. An interesting aspect about private debt when it comes to a CDI strategy is you've got that ability to negotiate or structure the deal at the outset and create almost the cash flows you need. So, for example, social housing regularly issues bullet bonds, 25, 30 years, but on the private side, you could negotiate something which is slightly shorter and amortizing, and perhaps is a better fit for your liabilities and your credit risk profile.
I think that's an interesting point. Can you hear me okay? I think that's a very interesting point, because I always worried about private debt, I must say, because while the income flow is there, it's not always predictable as to when it comes in, and the timing becomes an issue. So I think that's quite nice to hear that there's opportunities that you can actually amortize it in a more predictable way as well, which that's really good to hear, that I must say.
Yeah, I mean that's one of the attractions we see of private debt. It isn't just about the illiquidity premium. It's about tailoring something, to fit your, the profile you require as an institution and are comfortable with.
Yes, but is that opportunity available to smaller schemes? I would have thought a bit difficult, right? This is more larger investment tickets.
Yeah, I mean, yeah, I think it is a function of your, your buying and negotiating power, but and your ability to transact. But you could almost say it's a function of, how willing is the issuer able to meet the middle ground as well.
Yeah, good.
Sure. Okay. We may have answered this question already, and this might be quite a redundant question. It's quite interesting to ask. Shouldn't institutional investors, is it better to be cash flow aware or cash flow matched? I think the Times have probably answered that one. So anyone want to pick that one up?
I think it's both. I think I would have said, in my opinion, there's no right answer. If you have a well-funded scheme on a very short journey to a buyout situation, then I think a cash flow match position might actually work very well. If you have a less mature scheme, then I guess the longer end of the investment becomes quite challenging. And therefore, the opportunities may not be there to fully match it, but at least just being aware, and partial match would also be just as good, in my opinion. So that's how I think it would probably work out.
And we should also remember that for pension schemes, their liabilities change every 3 years. Yeah. So there is a redundancy in matching very, very closely, particularly at the longer end. So I think every scheme should be cash flow aware. They should have some idea of what their cash flows are and what their plan is to meet those cash flows. The more mature schemes can try and be cash flow matched, but like I say, liabilities change, and so being 100% cash flow matched is not necessarily in any scheme's best interests.
Yeah, I'm inclined to agree with Long.
Should we have Norbert first and then move on to Anand?
I'd cast my vote for cash flow aware. I think the variations are considerable. So yes, you need to be aware, but as for matching, that's a more fine matter of judgment. The key factor at the moment, I think, in these considerations is what the response of the employer is going to be, and the strength of the employer. The position that our members sort of play back at the moment is that the employers are reserving their position at the moment. They've got the opportunity of having more flexibility from the pension regulator, and they're just trying to work out how that might apply in practice. So there's a degree of volatility on that one at the moment.
And Norbert?
Yeah, I'm inclined to agree with the above. In a sense, I mean, it's really only if you're a pension fund with only pensioners that you can be more reliant on the liability profile, and you can say be a bit more matching with their cash flows. But for any pension fund that has non-pensioners, actives and deferred still, there's going to be the liability is changing not just on an annual basis, but even on a daily basis sometimes. And with the new pension freedoms and bulk transfer exercises and so on and so forth, it is very difficult to predict with any kind of precision what the cash flows are going to be like over the next month or even over the next 6 months or so. So some form of cash flow awareness and providing sufficient cash flows, perhaps slightly more than you think you need, if you can, and if you can afford it, and then and just see how it goes on a quarterly or on a semi-annual basis, and then keep on refining those cash flows and reinvest if you need to. Of course, there are risks there, but there's no point, I think, being too cash flow matched when there are so many uncertainties there, and especially when we know that most of the liabilities are based on assumptions from actuaries. So yeah.
Arnon, do you have anything to add?
Yeah. First comment, obviously, from an insurance perspective, we are forced to be more cash flow matched rather than cash flow aware, because the PRA test will force us to be, absolutely matched or duration matched within certain tolerances. And I can understand for pension schemes, whether you're cash flow aware or cash flow matched, it depends on your, individual circumstances. One thing I would say, and it was just echoing the point you made earlier about assumptions changing in liabilities. Even if you were cash flow matched and you had a buy and maintain strategy, I don't think it should be set and forget strategy, because one thing we're finding at the minute, as you said, as market and credit conditions change, you might want to engage in some relative value trading, whether that's to uplift the yield slightly on your portfolio or to buy into better quality names.
Yeah.
And this is where I think it's important in a cash flow driven strategy to make sure that you've got enough liquidity to employ that flexibility, as in you're not fully invested in a very high percentage of illiquids, where you don't then necessarily have the scope for rebalancing.
Yeah.
Yeah, I'll just add a short comment, is that I see cash flow aware and matched being basically the same thing, but on two ends of the spectrum. If you like, if you are very precisely aware, then you are cash flow matched. Like Anna said, I think the insurance regime is more well defined and specific about how the insurance companies should be cash flow matched. And this is where I think the pension scheme as well has the advantage of, I'm going to call it, sort of slight arbitrage in the regulatory arbitrage, because the cost of precisely matching, not only is there no complete benefit because the cash flows are unknown anyway in terms of the outgo, but also it's just not necessary. The cost is high. I'd also make a comment about, I have schemes that are less mature, has got quite a growth orientated strategy, but at the same time cash flow negative, which is quite unusual. I don't come across many schemes like that, and I would definitely put them in a cash flow aware category, not because they don't believe in cash flow matching, but because their overall portfolio risk and return profile requires them to have a very high growth content, but at the same time they do need to manage cash flows. So they're in this kind of halfway world where they haven't chosen to be cash flow aware, but it's just where they happen to be because of the overall circumstance. And I think that goes back to, for schemes that are in that position, that acknowledges cash flow is important, but haven't got the benefits of going into a CDI strategy, then they have to absolutely go back to understanding the point of cash flow, but they're not contractual, and therefore they have to plan for the day when those contractual or non-contractual cash flows actually don't come through, and then where are they going to find the liquidity?
Okay. A lot of pension schemes in particular are working towards an end game, and that end game seems to be more and more a buyout, with partial or full, and where we're seeing the numbers in that market racketing up and up and up and up. This disruption at the moment, if it turns out to be longer than just short term, and what kind of impact would that have on the buyout market and for pension schemes plans? Because some schemes I've spoken to are planning within the next 10 years to hand it all over to an insurer. So will this have any impact on those type of plans?
Yes, let me start. And so from my experience, I think it's nice to have a goal and an ambition and a target. I just worry that we may not necessarily get to our goal, because bearing in mind that if you have all the schemes in the UK wanting to do the same thing, by the time you get to the goal, whether the pricing will be right as well at that stage, I just have a question mark in my mind. But at the moment, I think those schemes which are on a journey path, I don't see their target period actually lengthening at this stage, because they're already invested in it and they just have to run it out, just have to make sure that they manage the risk in the process. And we said earlier on that I don't think any new schemes are actually, or new strategies are being implemented currently, because the situation is a bit more volatile than before. Yeah. So there's a mixture of schemes which are already on the journey. Then I think I'm not so sure there will be much of an impact. Just making sure that the risk is managed properly.
Gotcha. Anybody got anything to add to what we've just heard?
Yeah, I think there's a range of scenarios, but narrowing it down, perhaps say to a couple of them. I mean, I think those schemes that are fully hedged on interest rates and inflation and are reasonably well funded and are targeting buyouts, say in the short term, say 5 years or so, they're probably sitting relatively pretty at this point in time. But for the vast majority of pension funds, I mean, I saw a survey recently that roughly a third of pension funds are targeting buyout at some point in time, whether that's a short term or long term. But the vast majority of pension funds are still targeting something like self-sufficiency. And so, particularly many of the sponsors can't afford to stump up the extra cash to afford buyout. And particularly at this particular point in time, for example, when they're cash flow strapped, these companies are saying, they'll come to me with buyout. It targets something that's a bit more reasonable, low risk, self-sufficient, and let's manage it that way. So I think those are almost kind of like the two spectrums. There may be one or two things in between, but generally speaking, self-sufficiency seems to be, even though buyout is on the rise, I think self-sufficiency is still going to be the vast majority of targets that pension funds can reasonably afford. And so, yeah.
Okay. Time is pressing on a little now. We're getting to the last 5 minutes. So, but Celine, do you have anything to add?
Oh, I was just going to actually just agree with Dinesh that people often talk about having a target buyout in X number of years. The reality is that the world, it's good to have a plan, but the world will evolve the way it will evolve, and you can plan it all day long, but one may not get there because of circumstances outside of our control. And I give you an example that this is theory versus practice. Is 6 months ago, I have seen other people saying, oh well, actually you can target buyout in 5 years. If you take more risk now, you can actually get there quicker. Now, can you imagine if 6 months ago somebody actually took more risk? Right now, they will be absolutely behind plan. So again, it's really not just thinking about the plan or talking about targeting buyout in X years, but actually looking at market conditions and think about whether that's actually practical or not.
As Margaret Thatcher said, you can't buck the market, and there will be factors which we as yet have not had an explanation and will change. So I think, yes, watch this space seems to be the lesson on this one.
Gotcha, okay.
It does seem a little bit interesting, shall we say, that you have to be taking a whole lot more risk in order to end up in a no-risk position. Doesn't make any sense. But
not my advice.
Gotcha. Time is catching up with us now. We're up to the hour mark. Just one final point, and you can't have a conversation with this at the moment without talking about ESG. Are ESG factoring into these CDI strategies? Dinesh, how about you? How about the schemes you're representing? Is it something they're talking about?
Yes, so I think the conversation initially started with ESG mainly focusing on equities. But now, as more and more schemes are investing in credit, so that conversation is now spilling over into the credit markets, and underlying CDIs is all credit essentially. So I'm finding that there's a lot of conversation happening around ESG when building and constructing a CDI portfolio. And I understand that in the credit space, there's a lot more engagement on the ESG, which is quite a good idea. That's what I hear from the asset managers. And so, yes, there is there is a lot happening in that ESG space, and people are taking that into account. Now, the question is, do we have enough visibility of that at this point? I'm not so sure. That I think should come maybe in the next 12 months or so, as more and more work is done on reporting and how do you meet your regulatory duties in that area. But I feel, talking to them informally, I feel there is a lot of work in the background going on the ESG front.
Quite difficult, the lack of quality data. I mean, Claire, is this something your clients are talking to you about generally, about getting into credit?
Absolutely, yes. I mean, we talk to our clients regularly about ESG, and clearly in the last 2 or 3 years it's become a very important part of our investment process. So our analysts take into account ESG factors when they're doing their fundamental research, and these are flagged to the portfolio managers whether or not they're material for the creditworthiness of the issuer. And that obviously allows the fund managers to incorporate those ESG factors when building the portfolios. So we now have a lot of information on that. We are able to pass that on to our clients. We're getting much better at that. As Dinesh says, that's only going to get better over the next 12 months. And certainly for larger segregated clients, we can build bespoke ESG or bespoke portfolios that take into account any ESG factors. So we have some clients who, for instance, want to exclude issuers with a particularly high weighting of their EBITDA coming from thermal coal, for example. And we're able to do that because we have all of that information available to us now.
Good. Yeah.
Anyone else like to make a final comment on ESG?
I think certainly, absolutely, a lot more clients have been focused on ESG, particularly within credit markets. And I think perhaps almost coincidentally, those pension funds that have designed their CDI strategies or any of their strategies with ESG in mind would have perhaps been a bit more resilient during this crisis. Because when you think about the carbon-intensive businesses that have kind of not performed well over the last month or so, you know, businesses like travel and oil and energy, they've seen some kind of decline in their portfolio or in their stock values. And so, you know, if you've invested in those types of non-ESG focused type strategies, perhaps you wouldn't have performed so well. So yeah, I think I don't know whether it's kind of coincidental, but generally speaking, when I've spoken to a couple of clients recently, they seem to have been a bit more resilient over the last couple of months or so.
Kunal, do you have anything to add on an ESG and CDI?
Yeah, I think clients are increasingly aware, particularly after the requirements for reporting that were brought in last year, of you know, how their managers are actually incorporating this. I think managers have been I guess talking about it for a while now, but it's becoming more meaningful. You know, given the focus is fixed income, the G element, the governance element of ESG would have been in place for some time, particularly with the bottom-up analysis that most credit analysts would undertake. The focus on E&S, I think, can vary between managers and approaches. I think you know, we've had instances in the past where managers have perhaps held on to or bought positions in troubled areas, like for example Venezuela. You know, the crisis when that was occurring, which sort of really gave an insight to you know, how the ESG criteria and screening process really worked. But yeah, I think there's going to be an increasing focus on ESG, particularly given recent events. I echo Norbert's comments on those energy sector troubled areas. You know, there's a lot of talk at the moment about focus on renewable energy going forwards and infrastructure development that's that way inclined. So yeah, I would imagine, particularly given the timeframes that our pension schemes are investing in, you know, that ESG focus would be an increasing factor for them to consider.
Hey guys, if nobody has a final comment to make on that topic.
Just final comment. The only thing I'd say on what's just been said is, if you've got the immediate threat at the gate, as it were, you've got to deal with the immediate threat. But that doesn't mean to say that longer term threats don't remain. So yes, the ESG and the like should remain firmly on the agenda for the future.
Yeah, I'd also just echo one point made earlier about the long-term risk here. I mean, ESG you would think would fit in a CDI strategy because you are investing for the long term, and
That's right.
you know the ESG due diligence will actually help you measure that long-term risk. Will these cash flows deliver when you need them to? And businesses which have got sound governance and sustainability models will be more likely to deliver those cash in the long term as the ESG trends evolve.
Okay, guys, thank you very much for your time this morning. I thought it worked quite well. Thank you very much. Very interesting. Hope you all got something out of it, and I look forward to maybe meeting a person face to face sometime. That would be great. But thank you very much for your time, guys.
Thank you,
Thank you very much.
Thank you.
Everybody as well.
Thank you.
Thanks.
Goodbye. Goodbye.
Bye.